Usually when you think about the crypto market, the image that comes to mind is like a casino, right?
Oh, yeah, absolutely.
It's loud, it's chaotic, there are flashing lights everywhere, and everyone is just sort of gathered around the roulette table waiting to see where the ball lands.
Right. It's always been seen as high risk, high reward, and totally detached from the traditional financial system.
Yeah, exactly. For years, the general public perception has just been pure speculation. But imagine standing in the middle of that loud, chaotic casino, and someone just opens this heavy steel door in the back.
Yeah.
You step through, and the environment just instantly changes. It's a bank vault.
Ah, I see where you're going with this.
Right. It's quiet. It's meticulously efficient. There are these huge institutions moving massive pallets of regulated money around, and everything is plugged directly into the underlying plumbing of Wall Street.
Yeah.
That is exactly what is happening in the digital asset landscape right now in August 2026. The narrative has completely shifted.
It really has. We are looking at a market that is fundamentally reorganizing itself right before our eyes.
Yeah.
The maturation of this asset class, it's accelerating way faster than traditional financial models ever predicted.
Right. And so to understand the mechanics of this shift, we're doing a deep dive today into a stack of daily briefings from the blockchain newsletter, Nifty Noon.
Right, Nifty Noon. They've had some great coverage lately.
They really have. We've synthesized their reporting from August 2026 to sort of give you the ultimate cheat sheet. Sure. So whether you are prepping for a fintech strategy meeting, tracking macro trends, or just trying to figure out where the global economy is heading, we're going to break down this perfect storm.
This is a perfect storm.
Because the market is getting a double dose of rocket fuel right now. You've got massive macroeconomic liquidity injections colliding head-on with a fractured, but honestly monumental regulatory shift in the U.S.
Yeah, and the collision of those two forces, the money and the rules, it makes this specific moment critical. Because you really cannot fully grasp the asset price movements without understanding the underlying policy changes that are driving them.
Okay, let's unpack this. Let's start with the raw fuel, the money. So the U.S. Treasury, under Secretary Scott Bessent, just announced they are doubling government debt buybacks to at least $4 billion per operation.
Right. $4 billion.
And the market reaction was just explosive. Bitcoin surged past $68,000. It started testing the $73,000 range. Ethereum pushed above $2,300. But here's the really critical data point. Crypto actively outperformed the U.S. stock market. Like on some of these rally days, traditional equities actually closed in the red while digital assets climbed.
Yeah, and that decoupling is a fascinating market indicator.
Really? Why is that so unusual?
Well, normally Bitcoin trades like a high beta tech stock, meaning when the NASDAQ sneezes, Bitcoin catches a severe cold.
Right.
It usually moves in tandem with high-risk equities, just with a lot more volatility. But seeing traditional stocks slide while Bitcoin surges, it suggests that capital is treating digital assets as a distinct macroeconomic hedge rather than just another risky tech stock.
Okay, that makes sense. It feels like the Treasury just turned on a giant vacuum cleaner for yield.
Yeah.
Like the government is essentially sucking up its own long-term debt from the open market.
Exactly.
And when they buy that debt, bond prices go up. And the yield, the interest rate those bonds actually pay out to investors, that drops.
Yeah, the yield gets crushed.
Right. So if I'm a massive institution and my safe traditional bonds aren't yielding a meaningful return anymore, aren't I basically being forced to park my billions in alternative assets like Bitcoin just to find some kind of return?
Yeah, you hit the nail on the head. That vacuum effect is what economists call the opportunity cost of holding non-yielding assets.
Okay.
Because when traditional safe haven assets like long-term treasury bonds, when they offer high yields, large institutions have very little incentive to take on risk.
Right, they just sit in bonds.
Exactly. They sit in bonds, they collect a steady 5%, and they sleep soundly. But when the Treasury intervenes and drives those yields down to the floor, the mathematical calculus completely changes.
Wow, yeah.
Holding an asset that doesn't pay a dividend or a coupon like Bitcoin or gold, it suddenly becomes much more attractive because the penalty for holding it, the yield you're missing out on elsewhere, that basically disappears.
And the internal reporting from Nifty Noon shows just how fast that institutional capital is actually moving. Like over a 5-day period in mid-August, U.S. spot Bitcoin ETFs saw $853.5 million in net inflows.
It's staggering.
It is, and it's turning into a monopoly board. BlackRock's IBIT fund vacuumed up over 80% of that. That's about $694 million just to them.
Yeah.
And looking at the single-day volume peak on August 20th, it was over $5.3 billion for spot Bitcoin ETFs. And BlackRock accounted for $4.4 billion of that single-day volume.
Right. And a $5.3 billion single-day volume metric, that means sovereign wealth funds, state pension funds, and massive asset managers are actively executing trades.
They're not just dipping a toe in.
No, not at all. They are utilizing these ETFs because they offer a legally compliant, highly familiar wrapper.
And that's the beauty of the ETF structure for Wall Street, right?
Right.
They completely bypass the headache of self-custody.
Exactly.
I mean, a pension fund manager doesn't want to figure out how to safely store a USB hardware wallet that has $1 billion in private keys on it.
No, that would be a nightmare for them.
Yeah, they want a ticker symbol. They want something they can buy through their existing prime broker with the same tax structures and legal protections as a standard index fund.
And that massive influx of institutional, highly regulated capital, it forces the government's hand.
Right.
Because you cannot have billions of Wall Street dollars flowing into an asset class every single week without federal regulators desperately needing some sort of framework to oversee it.
Which brings us to the second half of our double dose, the rules. So the influx of capital is colliding with this fascinating tale of two Washingtons.
Yeah.
On one side, you have a gridlocked legislative branch, and on the other, you have administrative agencies basically deciding they can't wait any longer.
They're taking matters into their own hands.
Right. So let's look at Congress first. The big hope for the industry was the Clarity Act, right?
Right.
This comprehensive crypto market structure bill.
That was the golden ticket, yeah.
Yeah, and back in May, analysts at Galaxy Digital put the odds of it passing in 2026 at 75%. But they've just slashed those odds to 10%. The bill has completely hit a wall.
It has. And the legislative stall really comes down to the underlying mechanics of traditional banking. Lawmakers are aggressively arguing over stablecoin yields.
Okay.
Because if a regulated stablecoin can pay a 5% yield natively on a user's smartphone, the fear is that everyday people will just pull their savings out of traditional banks.
Oh, wow. Yeah, why wouldn't they?
Right. And that would starve legacy banks of the retail deposits they desperately need to issue mortgages and small business loans.
That's a huge systemic risk.
It is. That threat to the traditional credit system is the real fear holding up Congress. And you compound that with disagreements over developer protections, plus a shrinking Senate calendar ahead of the elections, and it's just stalled out.
So what does this all mean then? Because when the legislative branch stalls, the executive agencies step in to fill the void. I saw that CFTC Chair Michael Seelig publicly threatened that if the Clarity Act fails, the CFTC will just build its own crypto market structure from scratch.
Yeah, they're not waiting around.
And over at the SEC, Chairman Paul Atkins has actually put pen to paper. He's proposing this landmark framework called Regulation Crypto Assets, or Reg Crypto.
Right. And Reg Crypto, if we connect this to the bigger picture, it's an attempt to finally clarify how tokens can be raised legally in the United States.
Okay.
It's shifting away from the era of regulation by enforcement, where startups only found out they broke a rule when they actually received a lawsuit.
Which is such a terrible way to operate. The proposed framework from Atkins sets up two distinct tracks. There's a startup track allowing eligible issuers to raise up to $5 million over 4 years. This means a founder doesn't have to hire a $1,000 an hour securities lawyer just to launch a prototype.
Exactly. It lowers the barrier to entry.
Right. And then there's the expansion track, which allows up to $75 million over 12 months, provided they meet strict financial disclosure and ongoing reporting requirements. But the most significant piece of this proposal, I think, is the conditional safe harbor.
Yes.
It provides an actual pathway for a token to eventually shed its status as a security.
And the mechanism of that safe harbor is vital for decentralization.
Oh, so?
Well, the SEC is outlining a process where if the original founding team steps back and the blockchain network matures to the point where it essentially runs itself, meaning no central group is pulling the strings or driving the price, the token transitions, it ceases to be treated as a security contract and becomes recognized as a decentralized commodity. It gives builders a clear finish line.
But isn't this just a regulatory Band-Aid? I mean, if Congress can't pass the Clarity Act, Aren't crypto builders just trapped in a jurisdictional tug-of-war between federal agencies and state laws?
That is the big tension right now.
Because we are seeing this exact friction play out right now with Kalshi. So for our listeners, Kalshi is a prediction market where users can essentially trade contracts on the outcomes of future events.
Right.
And the New York Attorney General is actively trying to shut them down, arguing the platform is just an unlicensed gambling ring, and they're seeking $36 billion in damages.
Yeah, it's a massive lawsuit.
And just to be perfectly clear here for our listeners, we are not taking sides here. We are strictly impartial regarding the underlying politics of the New York AG's lawsuit or the federal stance on the Clarity Act. We are purely analyzing the mechanics of this policy battle.
Absolutely. No endorsements here, just looking at the structure.
Right. But the CFTC immediately invoked emergency powers to protect Kalshi. They basically stepped in to block the state.
Yeah, because the CFTC views these event contracts as federally regulated financial instruments under the Commodity Exchange Act. They see them essentially as tools for businesses and individuals to hedge risks, not a roulette wheel.
Right.
And the Kalshi situation, it illustrates the fundamental philosophical divide here. You have federal regulators arguing that registered financial platforms cannot be subject to a patchwork of 50 different state-level gaming laws.
Yeah, that would be chaos.
It would. So even if the SEC's Reg Crypto is just an agency-level rule and not a comprehensive congressional law, it provides a national baseline.
Okay.
It tells the market exactly what the financial thresholds are and what disclosures are required. It's an imperfect solution to a stalled Congress, sure, but it establishes a functional environment for massive capital to flow securely.
And that agency-level baseline is exactly what gives traditional giants the confidence to actually deploy products. Moving from the theoretical rules to the practical infrastructure, we can see what all this regulated liquidity is actually building for the everyday consumer.
This is where it gets real.
Yeah, and the absolute poster child for this transition in August 2026 is the Robinhood Chain. So the internal reporting shows Robinhood launched their own Ethereum Layer 2 network, and in its first full month of July, it generated $3.6 million in fees.
Wow.
Right. That is 38% of all Ethereum L2 revenue, immediately beating out established native crypto players like Polygon and Base.
Yeah, and for anyone wondering, a Layer 2 is essentially a fast pass lane built on top of Ethereum.
Right.
It allows a company like Robinhood to process millions of micro trades for pennies in a matter of milliseconds, while still relying on the main Ethereum network to secure the underlying data.
And they already have $1.3 billion in total value locked, which is the total amount of user deposits securing the network. And they have over 420,000 real-world asset holders.
RWAs.
Right, RWAs. These are traditional assets, like U.S. Treasuries or corporate stocks, represented as tokens on the blockchain. Robinhood's L2 is basically giving their users a universal translator. The user opens their familiar brokerage app, they swipe to buy Apple stock or earn a yield on dollars, but under the hood, Robinhood is instantly translating that action into blockchain settlement.
It's seamless. By building their own blockchain infrastructure, Robinhood is quietly bridging roughly 28 million traditional retail users into decentralized finance.
Yeah.
The user doesn't need to know what a cryptographic hash is. They just experience faster settlement and lower fees.
Which leads us directly into the ultimate everyday use case driving this entire ecosystem, which is stablecoins.
Oh, absolutely.
The Genius Act, which was signed into law back in 2025, officially takes effect in January 2027. It requires all payment stablecoin issuers in the U.S. to hold either federal or state licenses.
Right.
And the Treasury is currently running a 60-day public comment period to finalize these rules, even though they missed earlier deadlines to get the guidance out.
Yeah, they're a bit behind, but providing a durable, undeniable legal framework for dollar-backed stablecoins is the catalyst for unlocking everyday commerce.
Well, the data proves the commerce is already here. In July, crypto card spending hit $759 million. That is 2.5 times the growth year over year.
That's a massive jump.
And the micro details of this data are what really matter. We aren't talking about crypto whales moving millions of dollars between offshore accounts. There were 9 million distinct purchases, with an average transaction size of about $86.
$86. That's the key right there.
Right. And 84% of that spending was in USDC and USDT stablecoins. So the user goes to a grocery store, swipes their crypto card, their stablecoins are instantly converted, and the merchant receives their local currency through traditional rails like Visa or MasterCard.
Yeah, and it is entirely frictionless for the merchant. They don't have to update their point-of-sale systems or take on the volatility risk of holding digital assets.
Right, they just get dollars.
Exactly. Meanwhile, it allows the user to operate completely outside the traditional banking layer until the exact millisecond of settlement.
Okay, here's where it gets really interesting, though. We can't talk about stablecoins without addressing the elephant in the room, which is Tether, the issuer of USDT.
Ah, yes. Tether.
The latest data confirms Tether finally secured a clean, unqualified 2025 audit from a Big Four accounting firm, KPMG. They physically counted the gold bars. They verified the Treasury bills. The audit confirmed that Tether's reserves exceed their liabilities by $6.8 billion.
Right?
But they haven't actually released the financial statements or the auditor's opinion letter to the public.
Yeah, and a hidden audit is a glaring omission for a company that has faced a decade of intense scrutiny over whether its digital dollars are actually backed one-to-one by real assets.
Right, and if you're listening to this and rolling your eyes because you've heard a dozen times that Tether is a house of cards, you aren't alone. I mean, isn't a secret audit a massive contradiction?
It certainly feels like one.
You finally get the gold star validation from KPMG, and then you refuse to show the homework. It feels like replacing the old trust me, bro attitude of early crypto with the trust me, KPMG said it's fine stamp.
This raises an important question, and you are absolutely right to be skeptical. In traditional finance, an audit is fundamentally useless if it isn't public. Transparency is the entire point of the exercise.
Exactly.
However, we have to analyze the market's behavioral response. Despite the lack of public documentation, consumer adoption is dramatically accelerating.
Yeah, that's true.
When people are spending an average of $86 executing 9 million transactions a month, they aren't treating this like a speculative investment.
Oh, they're buying coffee.
Exactly. They are buying coffee. They are paying for groceries. They are settling these payments on fast networks like Solana and Base. For the average consumer in emerging markets, or even the U.S., the day-to-day utility of the stablecoin has completely overridden the transparency concerns.
The speculative casino element is entirely gone at that level. It's just plumbing.
It's financial plumbing that works instantly, across borders, on weekends, without the 3-day settlement delays or hidden fees of the legacy banking system.
Okay, so let's pull all of these threads together. We are looking at an August 2026 landscape where the U.S. Treasury's massive debt buybacks are acting as a vacuum for yield, forcing unprecedented institutional liquidity into Bitcoin via highly regulated Wall Street ETFs.
Right.
At the same time, we have federal regulators of the SEC and CFTC aggressively carving out distinct rules of the road, like Reg Crypto, because Congress is locked in a legislative stalemate over the Clarity Act. And on the ground, real-world infrastructure like the Robinhood Chain and stablecoin payment cards are silently taking over daily transactions, turning digital assets into the invisible back end of everyday commerce.
We are witnessing the integration of an entire asset class into the global financial stack in real time. But, looking at the massive institutional inflows driven by the U.S. Treasury's yield vacuum, it introduces a critical macroeconomic tension point we haven't discussed yet.
Oh, what's the blind spot?
Well, as stablecoins become fully regulated everyday money under the Genius Act, and brokers like Robinhood push millions of normal users onto Ethereum Layer 2s, there's a bigger question.
Okay.
Will the traditional banking system successfully absorb crypto? Or will crypto completely replace the traditional banking backend without consumers ever even noticing the switch?
Wow.
And beyond that, if the U.S. government's debt buybacks are actively pushing domestic institutions like BlackRock and massive pension funds into Bitcoin to seek returns, what happens when foreign central banks realize the U.S. Treasury is effectively squeezing them out of the traditional yield market?
Oh, man.
If foreign nations can no longer rely on U.S. debt for stable, high-yield returns, they will be forced to look for alternative reserve assets. We might be watching the very early stages of a sovereign crypto arms race where nation-states begin quietly accumulating digital assets just to compete with Wall Street.
A sovereign crypto arms race. That is a massive paradigm shift. If central banks start competing with Wall Street ETFs for a mathematically scarce asset, the casino doesn't just turn into a bank vault, it turns into Fort Knox.
Exactly.
It's a lot to chew on. So, to our listeners, keep asking those hard questions. Look at the payment rails you use every day and ask yourself what is really running under the hood. Keep questioning the information around you.
Yeah, remember to look past the daily noise of market prices to see the permanent infrastructure being built beneath it.
Thanks for joining us on this deep dive. We'll see you next time.